There are million ways to make money in the market, but the irony is that all are difficult to find. This is from the book Trading Wizard, and the author name is Jack Swagger. We will discuss each chapter thoroughly, and I will also show the important part from the book. Probably the future market is the one of the least understood market by the most of the investors, and it was the fastest growing market from last 20 years. From 1988, the dollar value of all the future contract traded in the US exceed is approximately $10 trillion. Future trading involves contract for all commodities such as gold, financial instruments, and T-bonds for the future delivery dates. For example, if an automobile manufacturer needs a copper for a current operation, it will buy its material directly from a producer. If, however, the same manufacturer was concerned that copper price would be much higher in 6 months, it would approximately look in the cost at the time buying copper future now. This offset of future price is called a hedge. If copper price climbed during the interim, the profit of the future hedge would be approximately offset the higher cost of the copper at the time of actual purchase. Of course, if the copper price declined instead, the future hedge would result in a loss, but the manufacturer would end up buying it copper at a lower level than it would be willing to look in. While hedge, such as our automobile manufacturer, participate in the future market to reduce the risk of an adverse price move. Traders participate in an effort to profit from anticipated price changes. Many traders will prefer the future market over the cash counterpart for the trading vehicle for the various seasons. Standardized contract. Future contracts are standardized in the terms of quantity and quality. These the trader does not have to find a specific buyer or seller in order to initiate or liquidate a position. Second, liquidity. All of the major future market provide excellent liquidity. Third, the ease of going short. The future market allow equal as of going short as well as long. For example, the short seller is in the stock market who is actually borrowing stock to sell must wait for an upstick before an initial position, so such as buy restricted exit in the future market.
Third is leverage.
The future market offers tremendous leverage. Initially, margin required are usually equal to the 5 to 10% of the contract value. In the future market, margins do not imply particularly payments since no actual physical transaction occur until the experience date. Rather, the margin are basically good faith deposit. High leverage is the one of the attributes of the future market for traders. This undisciplined use of leverage is the single most important reason why the most traders lose money in the future market. Future pairs are no more volatile than the underlying cash price. For the matters, many stocks, the high risk reputation of the future is largely a consequence of the future factor. Fifth, low transaction cost. Future market provides very low transaction cost. Sixth, as a offset, a future position can be offset at any time during the market hours, providing price are not looked at limit up or limit down. Seventh, guaranteed by exchange. The future trader does not have to be concerned about the financial stability of the person on the other side of the trade. All the transactions are guaranteed by the clearinghouse of the exchange. Price moves in the future will closely parallel to those in the corresponding to the cash market. Keep in the mind that the majority of the future trading activity is considered in the financial instrument. Many traders are in the reality traders in stock, bonds, and currencies. In the next part, we will discuss about interbank currency is market defined.